You're listening to Capital Conversations and the show where the money moves and the deals get made. Every episode, we go deep with the people who've actually done it, the entrepreneurs who've built from the ground up, the investors writing the checks, and the industry leaders who know exactly where the capital flows. We talk business funding, investment strategy, and what it really takes to scale. No fluff, no theory, just straight up insight you can put to work. I'm your host, Glenn Gould, best-selling author, business funding expert, and your guide through the funding landscape. If this is the kind of business insights you're looking for, make sure to subscribe so that you don't miss an episode.
Welcome to Capital Conversations. In today's episode, we'll be exploring the world of business funding with insights from industry leaders and experts. Let's dive into today's conversation.
Today's episode is titled Collateral Unlocked, Financing with Unconventional Assets. Joining me are two guests, Maya Chen, an asset-based lending specialist who structures deals around receivables, purchase orders, subscriptions, and IP, and Ravi Patel, founder of a B2B SaaS and hardware hybrid who financed growth by monetizing recurring revenue and inventory. By the end of this episode, you'll have a practical playbook to evaluate assets you can monetize and scripts to use when you negotiate.
Maya, quick hello. Tell listeners in one sentence what you do and who you help.
Hi, Glenn. I structure asset-based lines and term facilities for growing companies that need non-dilutive capital. I help clients turn predictable cash streams and tangible assets into credit lines while calibrating controls so lenders feel comfortable and founders keep control.
Ravi, same for you. One sentence, what's your company and what funding challenge brought you to Unconventional Collateral?
Thanks, Glenn. I'm Ravi, founder of Kinetic Supply, which sells IoT-enabled equipment with a subscription analytics layer. We needed growth capital to fulfill big purchase orders, but didn't want to dilute further. Traditional VC wanted more equity. Banks wanted real estate we didn't have. So we explored monetizing our purchase orders, inventory, and recurring revenue.
Great. Let's start with the funding problem you faced, Ravi. Walk us through that moment. What was at stake and what options you tried before asset-based lending?
We had a transformational PO from a large distributor, $1.2 million in hardware and setup with 45-day terms. If we fulfilled it, AAR would jump, but we didn't have the cash to buy inventory. We pitched VCs, but their feedback was grow revenue then raise, which wasn't fast enough. Traditional banks asked for owner guarantees and collateral we couldn't provide. It felt like a gatekeeper moment. Either scale now or stall.
That profile is common. Borrowers who fit asset-based deals often have identifiable monetizable assets, invoices, POs, or predictable subscription payments, but lack real estate or sizable owner guarantees. Lenders focus on cash conversion, concentration risk, counterparty credit, and documentation quality more than balance sheet equity. If your receivables come from creditworthy customers and your subscriptions show low churn, those become real collateral in our underwriting.
Let's unpack the anatomy of these unconventional assets. Maya, start with accounts receivable and purchase order financing. How do you value them, and what are typical advance rates?
Subscriptions and MRR are increasingly popular collateral. How do you underwrite recurring revenue?
You need reliable metrics. ARR, gross churn, net dollar retention, ARPA by cohort. We stress test revenue for churn and concentration. A single large customer making up 40% of MRR reduces advance rates. Typical advances on subscription ARR range 20% to 50%, depending on contract terms and churn. For higher quality enterprise contracts with multi-year commitments, advances can be higher and the facility can be structured as a revenue-based term loan.
Inventory and IP. How do you treat those assets differently?
Inventory requires valuation and liquidity analysis. Finished goods in bonded warehouses with good turnover can support 30 to 60% advance rates, but slow-moving or custom goods are discounted heavily. IP is trickier. Licenses or patents tied to recurring royalties can be monetized if cash flows are predictable.
Often IP deals require third-party appraisals and are priced more conservatively, with lower advances and more covenants to protect the lender.
Let's get practical. What documents and controls will lenders ask for during underwriting and ongoing reporting?
Expected data room with customer contracts, aging AR schedules, bank statements, AP/AR reconciliations, POs, supplier agreements, insurance certificates, and audited financials if available. Controls include AR verification processes, monthly reporting, field audits, and escrow or lockbox arrangements for collections. Covenants often specify borrowing-based tests, maximum customer concentration, minimum liquidity, and reporting cadence, weekly or monthly statements, plus immediate notice of defaults.
Ravi, tell us the case study. How did your deal come together, step by step?
We started by running an internal audit, clean AR aging, prioritized POs, and pegged which inventory batches were sale-ready. We engaged Maya's firm to run a quick pre-qualification. The lender proposed a 3-part facility, a PO finance tranche to pay suppliers, an AR facility for invoiced sales, and a small MRR-based revolver. Negotiations centered on advance rates, reporting frequency, and a covenant limiting customer concentration. We accepted a 75% AR advance, 80% supplier pay on POs, and a 30% ARR advance. The lender required lockbox collections and monthly field audits. That combination funded the PO and kept us equity intact.
Maya, what negotiation scripts or clause language should founders use to preserve optionality and avoid hidden costs?
Start with clarity on scope. Our request is limited to eligible accounts and specific POs, no blanket lien on intellectual property. Ask for a cap on audit frequency and specify reasonable notice. Field audits limited to twice per year absent trigger events, 48-hour coordination window. Negotiate pricing floors. No penalty pricing increases for situations outside borrower control. And push for carve-outs on future equity raises. Lender consent not required for equity raises below a defined threshold or for strategic sales. Use these lines. We can agree to a secured interest in identified collateral only, and let's set a definitive list of excluded assets. Can you give a short sample script founders can use on the call when the lender brings up broad covenants?
Say, we understand controls are necessary. To align interests, can we limit liens to the defined borrowing base and exclude operating cash and IP? If additional security is required, let's tie it to clear triggers and a cap on the lender's recoverable costs. That frames the ask as cooperative, not confrontational.
Ravi, what red flags did you spot in term sheets, and what would you advise founders to avoid?
Watch for broad default triggers like material adverse change without definition, steep default interest rates, and clauses that let the lender sweep cash aggressively. We pushed back on a term that allowed immediate acceleration on minor covenant breaches. We negotiated cure periods and notice requirements. Also watch for onerous fees, facility fees, utilization fees, and inspection costs can add up. Ask for a schedule of all potential fees up front.
Before we wrap, let's give listeners a preparation checklist and timing guidance, fast bullets they can act on this week.
Checklist. 1. Clean AR aging and eliminate disputed invoices. 2. Aggregate customer contracts and highlight cancellation clauses. 3. Inventory list by SKU with cost and turnover. 4. Recent bank statements and AP/AR reconciliations. 5. Cohort MRR metrics and churn analysis. Timing. A good pre-qualification takes 48 to 72 hours. A full facility from LOI to funding can be 2 to 6 weeks depending on audits and legal work.
3 tactical next steps listeners can implement this week.
1. Run an internal AR and MARR quality check and flag top 10 customers. 2. Prepare a 1-page collateral summary listing eligible assets and expected advance amounts. 3. Create a short list of 3 lenders, a bank ABL group, a specialty ABL fund, and an alternative fintech, and request pre-qual calls. If you found this useful, subscribe to Capital Conversations for more tactical funding playbooks. We'll publish show notes with a sample covenant clause and the prep checklist so you can download it. Keep building. Let's talk capital.
Thank you for joining us on Capital Conversations. I hope today's discussion provided valuable insights for your funding journey. Remember, securing the right capital is a crucial step in building a successful business. Until our next conversation.
That's a wrap on today's episode of Capital Conversations. And if you got value from this, do me a favor, share it with one person who's in the game or trying to get in it. That's how we grow this community. If you're ready to take action on your funding, go to glenhasmoney.com and let's talk about what's possible for your business. I am Glenn Gould, and we'll be back next week with another conversation worth having. Until then, keep building, keep pushing, and go get your capital. Capital Conversations out.